Welcome to The Explainer. Today, we're doing a deep dive into one of the most common and, frankly, most frustrating tax issues for families paying for college. It's a problem that comes from a good place, right? You're using a tax-advantaged 529 plan and claiming a valuable tax credit. But, as we're about to see, the rules that connect them are incredibly specific.
So let's just get right to the heart of it. Here's the situation. You did everything you were supposed to do. You saved diligently in a 529 plan, you used that money for qualified college costs, and yet at the end of the year, you're staring at a tax bill for what you thought was a completely tax-free distribution. It feels wrong, doesn't it? But as we're going to find out, this outcome is actually baked right into the tax code by design.
So here's how we're going to tackle this. First, we'll get a handle on what this trap actually is. Then, we'll meet the two key players, the specific sections of the tax code that are clashing. After that, we'll look at the rule that connects them, walk through the exact math that creates this tax problem, and, most importantly, we'll finish with a clear, strategic solution to make sure this doesn't happen to you.
Okay, first things first, let's get our heads straight about this. The name 1099-Q tax trap is honestly a little misleading. It makes it sound like a penalty, like you did something wrong. You didn't. This isn't a penalty at all. It is the direct, unavoidable mathematical result of some very strict anti-double dipping rules that are woven into the tax code. Here's the nuts and bolts of it. When you claim a really powerful tax credit, like the American Opportunity Tax Credit, the law forces your hand. It says, hey, those expenses you used for that credit, you can't also use them to prove your 529 withdrawal was tax-free. This creates a shortfall, and that shortfall is what turns a part of your otherwise perfectly good withdrawal into a taxable event.
So to really get why this happens, we need to understand the two sections of the tax code that are at the center of this whole thing. You can think of them as two different benefits that are kind of competing for the same dollars. Section 529, which is all about your college savings plan, and Section 25A, which covers the education tax credits. On one side of the ring, you've got Section 529 plans. And these things are great, right? Your money grows tax deferred, and it comes out completely tax-free on the federal level as long as you use it for qualified higher education expenses, or QHE. And here's the superpower of a 529 plan. That definition of QHE is super broad. It's not just tuition. We're talking room and board, books, computers, all the big-ticket items. And in the other corner, you have the heavyweights, the tax credits from Section 25A. You know, these are so incredibly valuable because they're not just deductions that lower your income. A credit is a direct dollar-for-dollar reduction of the actual tax you owe. That makes them a huge priority in any kind of tax planning. And now, this is where you can see the conflict starting to take shape. Just look at the qualified expenses for the credits. For both the AOTC and the LLC, the definition is way, way narrower than it is for a 529 plan. See that key exclusion in bold? Room and board are explicitly not qualified expenses for either credit. And that right there, that's the fundamental incompatibility. That's the root of the whole problem.
Okay, so that difference in what counts as a qualified expense brings us to the rule that acts as the referee. The tax code has very specific rules. They call them coordination rules that are designed purely to stop you from using the same exact dollar of an expense to get two different tax breaks. And believe me, this is not buried in some legal jargon. It's stated in plain English right in IRS Publication 970, which is pretty much the Bible for education tax benefits. It doesn't get much clearer than that. The IRS is flat out telling you that you cannot use the same expense to justify both a tax credit and a tax-free 529 withdrawal, period. And this isn't just a suggestion in a booklet. It is written right into the law, into the Internal Revenue Code itself. You've got these two sections that perfectly mirror each other. One side, Section 25A, says you have to reduce your credit-eligible expenses by any tax-free money you got, like from a 529. And the other side, Section 529, says you have to reduce your 529 eligible expenses by anything you use to claim a tax credit. They lock together like puzzle pieces to make sure there's absolutely no double dipping. So let's move on from the theory. How does this actually play out with real numbers? Let's walk through the math step by step to see how a totally well-meaning family just trying to do the logical thing walks right into this trap.
The calculation really has four main steps. You start with your total college costs, you back out any free money, like scholarships, and then, and this is the absolute key, you must subtract the expenses you use to claim that tax credit. For the AOTC, that's almost always the first $4,000 of tuition. What you're left with is a new, really important number called your Adjusted Qualified Education Expenses, or AQEE. Just think of that AQEE as your new spending limit for tax-free 529 money. All right, let's put some real numbers to this with a super common scenario. Let's call our student Student A. Total costs for the year are $22,000, split between tuition and room and board. The family does the logical thing. They take a $22,000 distribution from their 529 to cover the whole bill. Then, when tax time rolls around, they claim the maximum American Opportunity Tax Credit. I mean, that sounds perfectly reasonable, right?
But here comes the math the law requires them to do. We start with their $22,000 in total expenses. But because they claimed the AOTC, we are forced to subtract the $4,000 in tuition expenses that they used to get that credit. So that shrinks their adjusted qualified education expenses, the amount that can be covered by a tax-free 529 distribution, all the way down to just $18,000.
And there it is. That's the trap. They took out $22,000, but the IRS says they can only justify $18,000 of it as a qualified tax-free withdrawal. That $4,000 difference is now officially reclassified as an excess distribution.
Now hold on, it's not quite as bad as it sounds. The good news is that the entire $4,000 isn't taxed. According to the rules in Section 529, it's only the earnings portion of that excess distribution that gets counted as taxable income. The part that was your original contribution, your basis, always comes back to you tax-free.
So how do we figure that out? Well, you'll look at the Form 1099-Q you get from your 529 plan. Let's say, in this case, of the $22,000 they withdrew, $5,500 was from investment earnings. That means their account has an earnings ratio of 25%. So we just have to apply that same 25% ratio to our excess distribution. And the math from here is pretty simple. 25% of that $4,000 excess distribution is $1,000. That $1,000 is now considered taxable income, and it's going to show up on Schedule 1 of their Form 1040. So by trying to get two tax benefits from the same $4,000, even accidentally, the family just created a $1,000 tax problem for themselves. Okay, so now that we know exactly how the trap is sprung, the big question is, how in the world do we avoid it? Well, the solution isn't about giving up one of these great benefits. It's all about a simple but really powerful strategy for how you allocate your expenses and where the money comes from. The best way to think about this is as an optimization problem. The American Opportunity Tax Credit gives you a way better bang for your buck than the tax savings from a 529 withdrawal. So you prioritize it. You carve out that first $4,000 of tuition and fees, and you pay for it with cash or out of a regular savings account. Then you use your 529 plan to pay for literally everything else. And this just shows you how perfectly it can work. Look at this. By paying that first $4,000 of tuition with cash, the family locks in the full $2,500 AOTC. Then they withdraw $18,000 from the 529 to cover the rest of the tuition, that's $6,000, and all of the room and board, that's $12,000. Now their 529 withdrawal of $18,000 perfectly matches their AQEE of $18,000. The entire 529 distribution is 100% tax-free, no excess, no taxable earnings. Problem solved. So, if you remember one thing, remember this. This isn't a trap to be scared of, it's an optimization problem to be solved. You always prioritize the AOTC. I mean, a 62.5% effective return on your money is just unbeatable. You do that by paying that first chunk of tuition from an outside source, and that frees up your 529 plan to do what it does best, cover all those other costs, especially room and board, completely tax-free. Oh, and one last thing, make sure you take that 529 distribution in the same calendar year that you pay the expense. Timing is critical.
You know, this whole thing really points to a much bigger idea in tax planning. So often, the things we call traps are just the result of these really complex coordination rules between different parts of the tax code. It kind of makes you wonder, what other so-called traps out there are actually just opportunities for us to be a little bit smarter and a little more strategic in our planning?